Hello, everyone. Welcome back to our weekly webinar series for corporate tax. My name is Faiza Hashmi. I'm the tax director here at Crest Cooper. I'm going to be joined by Mahar Afzal, our managing director, and together we are going to take you through the topics for today. So the topics for today, we're going to do a recap on tax registration, which is a hot topic for right now. And we're going to discuss some latest developments. And then we're going to do the topic for today, which is on tax grouping. So as I said, that this is our weekly webinar series. We've already covered a lot of topics. As you can see that this is our 17th topic. And if you want to find out more about any of these topics, then you can visit our YouTube channel. You will find all the previous lectures there. And if you have any questions regarding those, then you can contact us. So I'm going to take you through a recap of our lecture for corporate tax registration that we did, because since it's a very hot topic, on May 15th, FTA started sending notices also to a lot of companies, and they opened the registration for public joint stock companies and private companies and asked them that they can register now and obtain the tax registration number. So at the moment, I have only asked the free zone persons and the natural persons to wait. The tax grouping is not available at the moment. So all the entities will have to register individually first. And then when tax grouping will be allowed, then they can register as a tax group. So FTA had also taken out a corporate tax registration guide. As you can see, these are some of the features of the guide. It's very detailed. It gives you all the information you need how to register. And today, the one highlighted in blue, we are going to discuss those in detail. So we are going to take you through how you can register in the Tax platform. So first of all, if you don't have a login detail or a profile at Tax platform, you will need to get one. If you already have a login ID, then you will see a list of all the taxable persons which are connected to this ID, to this profile. And then you will click on the taxable person which you want the CT registration to be for. When you do that, then there will be information required under the portion of entity detail. Here you need to put what type of entity the company is, what is the category, which country is for the incorporation, what is the date of incorporation. So for this, you will see a drop-down menu will come, and there's a lot of categories right now. Only the first two are allowed to register. So the UAE public joint stock company or a private company, when all the other natural person and the legal trusts and charity and foundation, they will be allowed to register soon. After the entity detail, you will then find a portion for identification detail. Now notice that if you want to move through one section to the next, you will need to complete all the mandatory field on the first section before you can move on to the next. So after the entity details comes the identification detail. There, all the details from your trade license will come. So who is the issuing authority for the license? What is the number of the license, the date, the expiry date, the legal name on the trade license. So after you fill in all this information, it will ask you to give information about your business activities. So which industry does the company pertain to? What is the main head? What is the activity that the company is doing? And after you've completed that, then we have to add the owner detail. So this owner detail, they want you to add all the owners who have a holding of 25% or more. So you will have to keep on adding all the owners till all the ones with the 25% or more are done. For the owner detail, they will ask you what type of person they are, again, natural person, legal person, what is the name in English and Arabic, what's the start date of the ownership, what's the percentage. And then there will be a portion for you to put in the details about the branch. So as many branches as you have to keep adding the details for the branch. Then will come the contact detail. Now here, it's important to note that this is where the head office detail will come, and not if you have a couple of branches, those details will not come here. They will be coming in the previous section where they have asked you to add the branch. So here there will be the detail about where the address is, the mobile number, the code, the PO box. So all that information will come here for the main head office company. Then we have a portion for authorized signatory. Here in the authorized signatory in detail, you will have to add, this is just like the VAT registration. If you have gone through that before, you have to give the name, the designation, the mobile number, if there's UAE residence, then email ID, passport details, and you have to give a power of attorney or a memorandum of association for this authorized signatory. So this is a summary. So just to recap, you have to log into your Amara tax portal. List of person will be displayed there. You have to select the taxable person, then register for corporate tax and click on the tile for corporate tax. There's be an instruction, you have to check mark it and go forward for start. Then fill in the entity details, the identification details, contact details, the authorized signatory details. After you've reviewed all the information, you will have to check and submit this application. Now, once you submit this application, then FTA is going to review it. They may accept it, reject it, or there might be a resubmission and they will ask for more document. For this, make sure that all the documents you're using are up to date and they're not expired, and all the information you're putting in, it's supported by, the documents. And then once this is done, any decision by FTA will come in your authorized email address, and you can also see the status in the Amara tax portal. Now I will hand it over to Mahar, who's going to discuss the latest developments and also take you through today's topic.
Thank you very much, Faiza. Thank you very much for your support, and thank you very much for the clarification on the registration in detail. So what we are going to discuss today, we are going to discuss latest development. One ministerial decision has been introduced. This is 114 of 2023. And after going through this ministerial decision, we will discuss the tax grouping once again. In our last lecture, we have discussed the tax grouping. The session was not live streamed at the time. I think there was some more clarification what people were asking, so we decided to go for tax grouping once again. So this ministerial decision 114 of 2023, it was published on 9th of May 2023. So this is the summary of the decision. Basically, this is specifically dealing with the financial statements and consolidated financial statement. We have summarized it like this. If the revenue of the taxable person is up to 3 million, it has been given in the ministerial decision, then these taxable person may apply cash basis of accounting. They can apply they can prepare the financial statement on the cash basis of accounting. And we have already discussed that the audit is compulsory for the taxable person having a revenue of more than 50 million dirham in a tax year. So since the revenue is only 3 million, so audit is not compulsory. First, like we can say, if your revenue is less than 3 million, then you can prepare the financial statement on the cash basis, and audit is not compulsory. In the same way, the entity, the taxable person having a revenue up to 50 million, then it has been given in the ministerial decision, these taxable person may apply IFRS for SMEs, small and medium-sized enterprises, and audit is not compulsory for them as well. And in case the revenue is more than 50 million during a tax year, then they need to apply the full-fledged IFRS to prepare their financial statement, and audit is compulsory for the taxable person like this. Now the question arises, the more important question, a lot of people are asking that they need to get an audited. In case there is a group, for the group, they need to prepare the consolidated financial statement for the whole group. So there are 15 entities in the group. Out of those 15 entities, they have just a group, the commercial group, the 15 entities. Out of those 15 entities, 10 entities are part of the tax group. So do they need to prepare the consolidated financial statement for the 15 entities? Yes, they need to do this because they are usually doing as per the IFRS. Now the tax group is only of 10 entities. Do they need to prepare the consolidated financial statement for the 10 entities? Yes, the law requires each and every members of the tax group, they need to prepare the individual financial statement. Along with the group company, the parent company needs to prepare the consolidated financial statement as well. It has been very clearly written in the ministerial decision as well. They said the preparation of the standalone financial statement on the basis of aggregation on the standalone financial statement of the parent company and each subsidiary that is a member of the tax group, eliminating the all transactions. So we'll discuss in detail in the tax group. On overall basis, we can say, by just summarizing this ministerial decision, if the revenue is less than 3 million, you can apply cash basis of accounting. If the revenue is up to 50 million, you can apply IFRS for SMEs, if the revenue is more than 50 million, then you need to apply full-fledged IFRS, and the audit is compulsory. Audited financial statements are compulsory for such taxable persons. The group, the parent entity, needs to prepare the consolidated financial statement for the tax group, and each individual member of the tax group, they need to prepare their financial statement as well. So this is a tax group we have already discussed before going into the detail. Last time even I have kept this diagram in front of you. I'm going to discuss the same thing. Assuming this is the UAE based parent company A, this company has multiple entities under it. The one is B LLC, second is C LLC, then the D Limited. Now the question is, A can go for a grouping with B Limited. Yes, A can go for a grouping with B Limited because the grouping conditions are at least the 95%. If we are going to discuss the grouping conditions first, these are the main condition that the entity can go into the tax group. The first entity, the parent company and subsidiaries are the resident juridical person. We know this, what are the juridical person? SMEs will not be supposed. Sole proprietors will not be part of the juridical person. Civil companies will not be part of the juridical person. Natural person will not be part of the juridical person. Juridical person means LLC, limited liability company, listed company. These all will fall under the definition of juridical person. The thin line difference in between the legal person and juridical person. Like sole proprietor is a legal person, civil company is a legal person, but these two are not juridical person. Juridical persons typically, other than civil company, other than sole proprietor, other than natural person, these will be juridical person. The first condition is the parent company and the subsidiary which are going to make a tax group, they all must be resident and they all must be juridical person. This is the first condition. Second is parent at least owns 95% of the share capital of the subsidiary. It can be directly or it can be indirectly. Another condition is that the parent company at least 95% of the voting right in the subsidiary. It can be direct voting rights, it can be indirect voting rights. In the same way, parent must be entitled to receive at least 95% of the profit and net assets of the subsidiary directly or indirectly. Along with this is required, it is written in the law that none of the potential tax group members is an exempt person. None of the members is a qualifying free zone persons. All of the members, potential members of the tax group, they have the same financial year, along with they have the same accounting standard. They are applying the same accounting standards. If these all conditions are being fulfilled, then the entities can go and make a corporate tax group. So based upon this definition, based upon this requirement of the law, if we are applying on these example, like company A is a UAE based company, B LLC 100% owned by A Limited. So B Limited can become a part of a group with A Limited because A Limited is holding 100% shares of the B Limited. Now in the first leg, B1 is only held 80% by the B Limited. So if I'm thinking A Limited is holding 95% in B Limited, no, because A Limited is holding 80% in B1 Limited. So A Limited is holding 100% in B Limited is holding 80% in B1. So at the end, A Limited would be holding 80% of B1. So B1 cannot be part of the tax group. In the same way, B2 Limited, A Limited is taking 100%, holding 100% shares of B Limited, and B Limited is holding 100% shares of B2. Though the 100% shares are owned by A Limited indirectly, still B2 cannot go for a tax grouping because B2 is a qualifying free zone person. We have just discussed the person who will be eligible to become a part of the tax group. They must not be an exempt person. They must not be a qualifying free zone person. So B2 is a qualifying free zone person. This entity will not be cannot be part of the tax group. In the same way, B3 100% owned by B LLC. But this is an exempt person. We have already discussed exempt person cannot be part of the tax group as well. So in the left leg, I can say out of the B Limited, B LLC can become a part of the tax group. B1, B2, B3 cannot be part of the tax group. Now coming to the middle leg, this is C LLC. A Limited is holding 100% shares of C LLC. Yes, C LLC can become a part of the tax group, and C LLC holding 95% shares in C1, it means A Limited is indirectly holding 95% shares in C1. So C1 can become a part of the tax group as well. So A Limited and C1 is holding 95% shares in C2. So indirectly, A Limited will not be holding 95% shares in C2. So C2 cannot be part of the tax group. In the last leg, D Limited, A Limited is holding 100% shares of D Limited, 100% owned by A, but based in UK and controlled and managed from the UAE. We have already discussed in the very first lecture, then if the entity is being controlled and managed from the UAE, it doesn't matter wherever the entity across the earth, it will be considered a resident person for UAE corporate tax law. So this is the resident person. D Limited is 100% owned by A Limited. So the condition, the basic condition, juridical person, resident, juridical person. D Limited is a resident person for corporate tax purposes. And D Limited is a juridical person. And at least 90% shareholding will be with the parent company. A parent is holding 100% shares in D Limited. So D Limited can become part of the tax group as well. Now you people will be thinking D Limited is registered, assuming in UK, D Limited will be paying taxes over there as well. D Limited will become a part of the tax group in the UAE. So how will be the treatment? So D Limited will be liable to pay taxes in UK. D Limited, once the revenue of the D Limited expenses will be consolidated with the A Limited, then the foreign tax credit rules will be applicable, and exemption and credit will be given to A Limited. Sorry, D Limited, whatever the taxes they have paid in UK, maximum up to 9% credit will be given to D Limited. At the end, D Limited will not be liable to pay any taxes in the UAE, but for presentation purposes, they will become a part of the tax group, and the revenue will be reflecting. At then when the tax will be calculated, they will not be liable to pay tax, because in UK the corporate tax is I think 19%. Here is a 9%. 9% credit will be given to D Limited. So D Limited will not be liable to pay any taxes in the UAE, but for presentation purposes, they will become a part of the tax group. Now the D1 Limited based in Abu Dhabi and 100% owned by D Limited. So again, resident juridical persons held 95% by the parent company. If all other conditions are being satisfied, so D1 will become a part of the tax group as well. D Limited, another company which is 95% owned by D Limited, and company is D2 Limited, 95% owned by D Limited, and the company is based in KSA. The company is being controlled and managed from KSA. If the entity is out of the UAE and this is being controlled and managed out of the UAE, so it will not be considered that the D2 is a resident person. So once this is the non-resident taxable person, so it cannot be a part of the tax group. I believe everyone is very clear regarding this, that which entities can become a part of the tax group and which entity cannot be part of the tax group. The main conditions are 95% shareholding, 95% voting rights, 95% right on the assets, 95% rights on the share capital, voting rights, same financial year, same tax period, and non-exempt person, not qualifying free zone person. If all these conditions are being satisfied, so we can say that you can go for a grouping. Once you have gone for a corporate tax grouping, then the relevant provisions of the corporate tax grouping can be applied. This is the one exception we have already discussed in our second lecture. The government entities are exempt from the UAE corporate tax law. But it has been very clearly written in the Article 40 of the law that if there is a government entity which is 95% held by the government, that entity can become a part of the tax group as well. But all other condition needs to be satisfied. Just all other conditions we have very just discussed, all other conditions needs to be satisfied, like share capital, voting right, profit and loss, and all these conditions are being satisfied. Then the government entity which is held 95% by the government can become a part of the tax group as well. So once the group has been formed, what will be the obligations? What will be the benefits to the group? So once the group is formed, we need to keep in mind it will be considered a single taxable person. The group will be liable to submit only one return. It will be a major responsibility of the parent company, the sole responsibility of the parent company. The parent company will be responsible for consolidation of the financials of each subsidiary. We have already discussed that each subsidiary will be required to prepare its own separate standalone financial statement. These separate standalone financial statement will be consolidated by the parent company. Even the parent company will have a separate standalone financial statement. So there's a parent company financial statement, subsidiary financial statement. All these financials needs to be consolidated. It will be the primary responsibility, sole responsibility of the parent company to get the financial statement consolidated, eliminate intra-group transaction, determine taxable income and filing a tax return, keeping a record, seeking clarification, admin and payment of corporate tax, applying for any refunds and addition and deregistration of the tax group. It will fall under the ambit of the parent company, and parent company will be liable to do this. In case of any tax liability, it has been very clearly written in the law that all the members of the tax group will be jointly and separately responsible for the tax group, but exception has been given if an application has been submitted to the FTA and FTA asking only specific members will be responsible for the liability of the group, then those specific members will be liable to submit and will be liable to pay any outstanding amount to the FTA. Movement in the tax group, yes, this is quite important thing. Once the tax group has been formed, new subsidiaries which fulfills the criteria, they can enter into the tax group, and subsidiary can leave the tax group as well. Even the parent can leave the tax group. Even the new parent can join and lead the tax group. All these possibilities are there. All these movements are there. And I would like to highlight the most important thing. The most important thing is once this tax group has been formed, and if any new subsidiary is joining this tax group, we need to keep in mind that subsidiary, if assuming the new subsidiary is joining and that subsidiary has its own pre-grouping losses, the pre-grouping losses of that subsidiary cannot be adjusted against the taxable income or taxable profits of the group. Taxable income of the group, these losses, pre-grouping losses of the new subsidiary can be adjusted against the taxable income of that subsidiary. Even the subsidiary is part of the tax group. This is a very important thing. So means the company A was bringing some sort of losses joining a group. Once the company was joining a group, company has some sort of losses. It cannot be adjusted against the overall group, but it can be adjusted against the future taxable income, future income of that subsidiary only. In the same way, if the group was existing before joining the subsidiary, the losses of that group cannot be adjusted against the new group profit, new group income, but it can be adjusted against the income of the pre-existing group only. This is important thing. In the same way, if any subsidiary is moving out of the tax group and making any losses, the losses of outgoing subsidiary cannot be adjusted against the taxable income of the group. But if the subsidiary has pre-grouping losses, that will be carried forward and it will be adjusted against the future taxable income of that subsidiary only. So this is the important thing. So how the entity can join and how the entities can leave. Once they are joining, how the adjustment of losses, and once they are leaving, what will be the adjustment of the losses. This is the important thing. And second more important thing is parent company. Parent company can leave the tax group, and if the parent company is not satisfying the conditions, even the subsidiary is not satisfying the condition, they need to leave the tax group. Even the parent is not satisfying the condition, parent needs to leave the tax group. In the same way, FTA voluntarily can intervene and they can replace the parent company of the tax group as well. And even the parent company can file an application to the FTA, and new parent company can join and lead the tax group. Once the new parent company will be joining and leaving the tax group, so it will not have any implication on the overall group basis. And another important thing is, if assuming all the subsidiaries are not satisfying the condition, then all losses will be held in the bucket of the parent. But if the parent is leaving, then the losses subsidiary will not be adjusted any group losses against their future taxable profits. So we'll go through all these things very quickly. a tax group can seize, we have already discussed that if the parent company can make an application to the federal tax authority, and once the authority is granting the approval, then the group will cease to exist. And even when the parent company no longer fulfill the requirement of the tax group, then this group will be closed, and with this group will cease as well. In the same way, substitution, a parent company, as I mentioned, basically the federal tax authority has powers that they can replace the parent company. The new parent company satisfy the conditions specified in the article regarding the format of the parent company. The new parent company, a subsidiary, is the previous parent company universal legal successor. When the former parent company ceases to exist, it can be replaced as well. So power of the federal tax authority, as I mentioned, the federal tax authority may in its own discretion dissolve the tax group or replace the parent company of the tax group. This is to be based on the information available with the federal tax authority. The federal tax authority will notify to the parent company of any such action. Date of formation of tax group, this is important. When this tax group, when the new subsidiary is joining, it will be assumed that the subsidiary has joined at beginning of the tax period in which the subsidiary has entered into the tax group, or any beginning of any other tax period as may be specified the FTA. So effective date will be beginning of the tax period. It may be in the same tax period in which the group has been formed, a new subsidiary has joined the group, or any other period beginning as may be specified by the FTA. Date of session of a tax group, once they are not satisfying the conditions, group will be seized, or we can say once the beginning, it will be a subsidiary wishing to exit, a group can file an application with the FTA for discontinuing its membership. The relevant date of when a subsidiary will cease to become a member of a tax group will cease to exist from the beginning of the tax period or any other specific date given by the federal tax authority. May cease to be a member of the tax group from the date it fails to meet the condition. As I mentioned, if the subsidiary is not fulfilling the condition, even the parent is not fulfilling the conditions, the same condition that were discussed in the very beginning of the lecture about the corporate tax grouping, if they are not fulfilling these conditions, the day they are not fulfilling those conditions, it will be assumed they are no more part of the tax group. Taxable income of a tax group, I discussed that the parent company is liable to prepare the consolidated financial statement of the tax group, but they need to prepare the consolidated financial statement of individual standalone entities. Each standalone entity will prepare their consolidated financial statement. Even the parent will prepare its own separate standalone financial statement. Then it will be the primary responsibility, sole responsibility of the parent company to prepare the consolidated financial statement. Then they need to make the adjustment. Same sort of adjustment will be all intercompany transaction will be removed. There will be adjustment for the gain and losses. There will be adjustment for the exempt income. There will be adjustment for the losses, and there will be adjustment for the transfer pricing, price adjustment as well. After making all these adjustments, the parent company will arrive at the taxable profits. So while arriving at the taxable profit, then they will, if there are any losses, we will discuss how the treatment of the losses on the taxable profit, they will be liable to pay 9% on the income beyond 375,000. Up to 375,000, 0% corporate tax will be applicable. Tax rate, we all know this, up to 375,000, 0% tax, and beyond this, the tax rate is 9%. Treatment of unutilized losses, I will discuss in detail. When any subsidiary is joining, what will be the treatment of losses? When any subsidiary is leaving, what will be the treatment of losses? When any parent is going out, what will be the treatment of losses? When all subsidiaries are going out, what will be the treatment of losses? The important thing is, till all the players are part of the WAD group, they can adjust their losses with each other. If any of them is not part of the WAD group, then they can adjust their losses only with their own taxable income. This is the golden principle. This is the key principle. If they are part of the group, from the date they are part of the group, then they will be able to adjust their losses against their taxable profits. Transfer of assets and liabilities. This is very important clause. When they are part of the tax group, any transfer in between the tax group, it will be assumed at the book value. Entity A, entity B, these are part of the tax group. If during the tax group entity is transferring any asset to the entity B, it will be assumed that the entity B needs to record this asset at the book value. There will not be any gain, any loss. But the condition is they need to be remain in the tax group for at least for a period of 2 years. If they are leaving, if anyone of transferor or transferee, they are leaving the tax group within 2 years from the date of transfer. So this transfer, it will be assumed that the transfer has taken place at the market value. Then we need to make another adjustment. We need to eliminate the book value impact. We need to bring everything on the market value, and the condition, they need to be a part of the tax group at least for a period of 2 years. Thank you very much. I think we are very clear on the which entities they need to get their financial statement audited, which entity they need to apply the cash basis of accounting, which entity they need to apply the full-fledged IFRS, which entities needs to apply the IFRS for small and medium enterprises, which entity need to get their financial statement audited. How can we make a tax group? Which entity can become a part of the tax group? What will be the adjustment of the losses? What is the role of the parent company? So what will the role of the parent company? Standalone financial statement required or not? Consolidated financial statement required or not? All these things we have discussed in detail. And thank you very much for your support. I really appreciate it. As usual, if you have any question, we are happy to help. We are always ready to listen. We understand and we deliver. You can drop us an email, info@crestcooper.com, or you can give us call as well. Thank you very much. Going back to your questions, is audit compulsory for a branch of a UK-based foreign company who has UAE revenue greater than 50 million? The UAE head office does not get their audit done in UK, but not separately. Okay, is audit compulsory for branch of a UK-based foreign company who has UAE revenue greater than 50 million? Because it will be non-resident, PE of non-resident. If the revenue is more than 50 million, I believe audit will be compulsory. You need to get your financial statement audited. Hello, can we get exemption for foreign registered company controlled from the UAE so that we can? Yes, if you have a PE out of the UAE, you have I think this is given in the article, I think article 24 of the law, if I'm not mistaken. Then if you can claim an exemption subject to the condition you are paying minimum 9% tax in the respective country. And if the exemption has been granted to you, then income will not be considered, related expenses will not be considered. It will be out of the scope for UAE corporate tax law. So in a tax group, each member losses is 375,000 threshold. So in a tax group, each member losses is up to 307. In a tax group, each member losses is 375,000 threshold. Now, basically, if you are becoming a part of the tax group, then on overall basis, we need to assess what is the threshold. On overall basis, it will not be considered each member 375,000. Overall group up to 375,000, it will be zero rated. Beyond that, it will be subject to tax at 9%. I am in UAE on visit visa, then opening in your firm. Not at the moment, but still you can drop me an email on the info@crestcooper.com, share your CV, and if any vacancy arises, definitely I'll come back to you. TRC will be required to avoid double taxation. Yes, I believe tax residency certificate will be required if the tax treaty exists, and TRC will be required to avoid the double taxation. To become a qualified free zone person, out of the four, one condition is entity should follow the transfer pricing rules of OECD, but that principle is applicable only where group revenue is more than 750 million euros. What about the entities who are not part of the group or group revenue is less than 70-50 million? We need to wait. We need to wait for the, very honestly, we need to wait for the decision from the FTA specifically on the qualifying free zone person and qualifying free zone income. They will give us a more clarity on which your question is very right, that as per the TP applicable, as per the OECD guideline, the revenue is 750 million euros. If the revenue is more than 750 million euros, all TP rules and regulations should be applicable. And at the same time, you are saying if they become a part of the VAT group, this is one condition out of this, they need to apply the TP rules and regulations. Second thing, at the same time, they say 750 million threshold is applicable as well. So this is very difficult to address this question unless and until we are getting a clarification from the FTA specifically on the qualifying income. Once we are getting clarification on the qualifying income, then because just I want to give you the background. We all know this, that the qualifying income of a qualifying free zone person is zero rated. All other income is subject to tax at 9%. So we know the definition of qualifying free zone person. We don't know the definition of qualifying income. We need to wait for the definition of qualifying income. Once we have a clarity on the definition of qualifying income, then we will be in a better position to address this question. So I'm parking these questions. Hopefully, I believe within the next 1 week, because corporate tax law is effective starting from 1st of June 2023. We have very limited time, hardly 1 week. I believe this clarification needs to be announced by the FTA within this 1 week. What is the qualifying income? Then we'll be in a better position to address this question. Another question is, as you said, now joining subsidiary losses can be carried forward and adjusted with the onward profit only and cannot be adjusted with the group profit. Yes, you are very right, Hasib. Why is this being mentioned separately? Eventually, it will be consolidated and those losses are lost. It means can never be adjusted again because subsidiary is not filing separately. Yes, but there are flip side as well. If entity is making losses, one loss-making entity is becoming part of the tax group, then why the other members should absorb their losses? This is the first question. They should not absorb their pre-grouping losses. Second important thing is, once the entity is becoming a part of the tax group, they will be adjust their losses on an overall basis. But there is a possibility in case the entity is coming out of the tax group, they can adjust their pre-grouping losses. So pre-grouping losses can be adjusted against the taxable income of the respective company. It cannot be adjusted against the taxable income of the group. Shahzad is asking, one UAE local national has its clinic in Qatar. One UAE local national has its clinic in Qatar, sole proprietorship there. So he is exempt of income tax there because he is a GCC national. Any question is that whether he is taxable under the UAE based on the income in Qatar? Law is very clear because if the UAE national is based in UAE and he is controlling and managing the entity from UAE, it will be considered UAE resident person. Once it will become a UAE resident person, law is saying it will be subject to tax in UAE and they will be given a foreign tax credit. If they are not paying any credit in Qatar, their whole income will be subject to tax at least at 9% in the UAE beyond 375,000. Karamlan is asking, so kindly share the notes slides till today webinar. Okay, share your email address. I'll send it to you. I have already sent to all of you. I think might be you have missed it. I'll send it once again. Asib is asking, what about the Saudi companies who conduct 15% withholding tax of the UAE registered person? Would you tell anything about this? Withholding tax, whatever they are deducting, they were giving it to the government of the Saudi Arabia. But under the for tax treaty, if you are producing tax residency certificate, I believe they will not hold this 15%. LLC can register now for corporate tax. Yes, you can register, but the law says at any time you can register before submission of your first corporate tax return. There is no timeline. The ceiling for the timeline is your first submission of your first tax return. Mubin is asking, by what date company needs to register for corporate? At any time you can get yourself registered, as I mentioned before, the submission of your first corporate tax return. We have two business entities in Lebanon. There one more question. We have two business entities in Lebanon and UAE free zone. In Lebanon and UAE free zone, okay, and paying salaries and other overhead expenses to Lebanon. Company from UAE, how to treat as per IFRS and CT law. Okay, let me read it once again. We have two business entities in Lebanon and UAE free zone. Okay, one entity is in Lebanon, one entity is in UAE free zone, and paying salaries and other overhead expenses to Lebanon. Okay, you are transferring here from the salaries and other overhead expenses. Company from UAE, how to treat as per IFRS and CT law. I am so sorry. It is very difficult for me to comment as per the IFRS. I will ask my IFRS team. They will definitely come back in case you are dropping us an email. But CT law purposes, if you are transferring any money from here to your company in Lebanon, from UAE to Lebanon, keep in mind that it will be assumed this is a loan, I believe, and transfer pricing rules will be applicable. You need to transfer the money. You need to charge interest as per the market value. And all these things we need to keep in mind. For the IFRS, you can drop us an email for sure. I will be happy to help. I will ask my team, they'll come back to you on this. One more question is there. Company has accumulated losses with the start of tax effective from June 2023. Will we have to maintain different books for the keeping track of the accumulated losses and losses profits during corporate tax period? Whatever your losses, the law is very clear. Law is asking the time that you are getting yourself registered, or sorry, from the effective date of the law, or from the time you are getting yourself registered. Before that date, you cannot adjust any losses against the future taxable profits. So it will be a straightforward different thing. Keep it a separate. No need to maintain a separate books of account. You can keep the same books of account, but these losses cannot be carried forward, and these losses cannot be adjusted against your future taxable profits. Harun is asking, do we need to consider DTA agreement of UAE with other countries while preparing corporate tax return? For sure, double tax treaty, you need to look into this while preparing the return. When will be the first corporate tax return submission date considering any financial period? I think I have discussed this thing so many times. I'm highlighting once more again. If your financial period is starting from 1st of July 2023, your tax period will be 1 year. Your tax year will be ended by 30th of June 2024. And from 30th June onward, you will have 9 months to submit your corporate tax return and to pay the payment as well if this is the due. So the businesses having a financial year starting from 1st of July 2023, they will be liable to submit their first return by 31st of March 2025. And if the business's financial year is starting 1st of Jan 2024, their first return will become due by 30th of September 2025. Hasib is asking one more question. Hasib is asking VAT related query. I have some VAT queries related to the designated zone company sales transaction for which I could not find answers in VAT law and clarification. Can you send me a scenario in email? Yes, you can drop me an email. My email is mahar@crestcooper.com. Definitely, I'll come back. It will be pleasure supporting you. A branch of a UAE free zone company of a, okay, one more question. They're asking a branch UAE free zone of a UK make invoice for their expenses to UAE company. Is there any impact of CT on such kind of invoice? A branch of a UK, okay, a branch of a UK make invoice for their expenses to UK company. Okay, UK company, the branch, they say basically PE of the UK company in the UAE. This branch is make invoice for their expenses. Any impact of the CT? Yeah, of course. Basically, there are two legs. First of all, these are the basically, if the branch is here, branch is making any expenses, so it will be considered allowable expenses, non-allowable expenses. This is the first leg. Second link, this is being financed by the other company. They're not basically other company, by the parent company. We need to consider the rest of the basically from the TP point of view as well, because these is a cross-border transaction. We need to look into that as well. Another question is, if a company is established in a free zone and sell goods to the distributor in UAE and in the Middle East and Africa region and record all sales in the UAE books, will this company pay CT only on the UAE sales or total sales? It doesn't matter how you are selling. The criteria is straightforward different. Criteria is, are you a resident person or not? If you're a resident person, your worldwide income is subject to tax. And the resident criteria, residency criteria is, the company is incorporated in the UAE, company is controlled and managed from the UAE. These are two major criteria. If these criteria are being fulfilled, then it will be assumed that the company is a resident person, and this company is resident person, then worldwide income will be subject to tax. If the company is paying any tax across the globe, anywhere, then the foreign tax credit rules will be applicable and exemption or credit will be given to the respective entity. But on overall basis, worldwide income will be subject to tax. Thank you very much. I'm happy to see your so many questions today, and players supporting you. And if I have not addressed any question, you can drop me an email. I'll come back to you. And if you are in need of any further support, you can give me a call at any time. You can drop me an email. I'll come back to you as I mentioned. Thank you very much and have a lovely day. Thank you very much. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.